From accounting systems to broker control, who is actually responsible? In the last section, we broke down accounting systems, trust accounts, and how to prevent violations through strong financial practices. Now we take that one step further into one of the most critical areas of broker responsibility: who controls the money and how it is handled. Because here's the reality: you can have perfect accounting systems, but if the wrong person has access to the funds, or if controls are weak, you are still exposed to major risk. This section is where accounting meets authority, supervision, and liability under Arizona law. Trust accounts must be properly designated under ARS. Paragraph 32, 2174, all property management accounts must be designated as trust accounts on the broker's records. This ties directly back to Section 11. We discussed what a trust account is. Now we're talking about how it must be formally structured and identified. For example, if a broker in Chandler opens an account but fails to properly designate it as a trust account, that alone can be a compliance issue, even if the money is handled correctly. Proper designation is not optional, it is required. Where the money goes: owner funds and broker limits. A broker is required to use a trust account for all owner funds unless the owner specifically directs that funds be deposited into the owner's account. However, there is a critical rule here. The broker cannot have access to the owner's personal account. For example, if an owner in Scottsdale says, "Just deposit rent directly into my bank account," the broker can follow that instruction, but cannot be a signer or have access to that account. This protects both the broker and the client from improper handling of funds. Who can be a signatory on a trust account? This is where things get very important. The designated broker may authorize either a licensed individual or an unlicensed employee to be a signatory on the trust account, but there are conditions. If the person is unlicensed, they must be a bona fide employee of the brokerage, not an outside contractor. For example, a full-time bookkeeper employed by the brokerage may be authorized to transfer funds or sign on the account. However, a third-party contractor cannot be given that authority. This is a key supervision issue. And here is the most important part. Even if someone else is a signatory, the broker is still 100% responsible. Delegation does not remove liability. Dual signatures and internal controls. Arizona law allows brokers to require dual signatures on checks and establish internal policies for financial controls. This is where strong brokers separate themselves from average ones. For example, requiring 2 signatures on large disbursements, such as vendor payments over $1,000, can prevent fraud and errors. Think of this as your internal risk management system, because once money leaves the account, it becomes much harder to fix mistakes. The 3-day rule: timing matters. Under ARS, paragraph 32-2174, funds that are not in dispute must be deposited within 3 banking days. This ties directly back to everything we discussed in accounting and audits. For example, if rent is collected on Monday, it must be deposited into the trust account or owner account if directed by Thursday. Holding funds too long, even if unintentional, can be considered a violation. Timing is compliance. Lease requirements: disposition of deposits. Every rental agreement must clearly state how tenant deposits will be handled. This connects directly to both the PMEA, Section 8, and accounting systems, Section 11. For example, the lease should clearly outline whether deposits are refundable, how they are held, and how they will be returned at the end of the tenancy. Clarity up front prevents disputes later. Record keeping, your audit protection system under ARS. Paragraph 32-2175, brokers must maintain detailed property management records, including leases, financial records, and transaction documentation. This builds directly on the record-keeping concepts we discussed earlier, but now with legal requirements attached. For example, residential lease documents must be kept for at least 1 year after expiration, while financial records must be kept for at least 3 years. If these records are not available during an audit, that alone can trigger violations. Organization is not optional, it is required. Who can sign lease agreements? Arizona law is very specific when it comes to non-residential leases. Only the designated broker or an authorized licensee may sign them on behalf of the broker. This reinforces the importance of proper delegation and documentation of authority. For example, if an unlicensed assistant signs a commercial lease, that could create a serious compliance issue. Authority must always be clearly defined and documented. Audit access. Be ready at any time. ADRI has the authority to request records for audit purposes, and brokers must provide them within a reasonable time. This ties directly back to Section 9, where we discussed audits and violations. If your records are disorganized, incomplete, or inaccessible, that becomes a problem immediately. Strong systems make audits smooth. Weak systems make audits painful. Penalties. What happens when things go wrong? Let's connect everything we've learned across Sections 9, 11, and 12. When trust account rules are violated, the consequences can be serious. These can include fines, license suspension, probation, or even revocation. In extreme cases, criminal charges may apply if funds are misused. For example, commingling funds, failing to reconcile accounts, or allowing unauthorized access to trust accounts can quickly escalate into major disciplinary actions. And beyond legal consequences, there is reputational damage, which can cost a broker their business. How this section connects forward. This section brings everything full circle. We started with violations, moved into accounting systems, and now we've defined who controls the money and how it must be handled. This is the core of broker responsibility in property management. As we move into the final wrap-up, everything comes down to one key principle. Strong brokers build systems, control risk, and take full responsibility, because at the end of the day, the liability stops with them. Online discussion. Why does assigning a signatory on a trust account not remove broker liability? Answer: because Arizona law places full responsibility on the designated broker regardless of who is authorized to handle the funds. What is the purpose of the 3-day deposit rule? Answer: to ensure timely handling of client funds and prevent misuse or delays in depositing money. Why are strong internal controls like dual signatures important? Answer: they help prevent fraud, errors, and unauthorized transactions within trust accounts.